Hello everyone, it's lovely to be speaking with all of you again. I hope you have been taking care of yourselves. Thank you so much for taking out time to be here today. The Third Empire series is all about keeping you up to date with key events and developments that took place during the week. Our aim is to provide you with a concise summary of what happened so that you can stay informed as an investor, even if you're busy and don't have time to follow the news on a daily basis. This series is similar to Daily Insights that Matter, but with more detailed analysis that you can watch at your leisure. Well, we call it the Third Empire series because when you are confused in the game of cricket, you seek the final verdict of the Third Empire to move ahead. With this initiative also, we attempt to remove the noise and present you the main points of an event that will enable you to take an informed decision as an investor. In today's episode, we will be discussing the IMF's revised GDP for India, the latest retail inflation and industrial production numbers reported by the government, and OPEC's decision to reduce oil production in light of recent geopolitical tensions. We will also be taking a look at how the new festive season is faring for some of the key sectors such as auto and retail industries. So let us begin today's session. IMF cuts India's FY23 growth forecast to 6.8%. CPI inflation rises to 5-month high of 7.41% in September. India's industrial production contracts for the first time in 18 months. These are the three macroeconomic developments we would like to discuss today. These certainly sound ominous. We certainly don't want to downplay how serious they are, but we do want to be clear about the messaging. Yes, inflation has risen again after showing a downtrend for 5 months. IIP slipped after an 18-month uptrend, and IMF has downward revised India's GDP by 60 bips to 6.8%. We are not disagreeing with the analysis, but is the state of the Indian economy really as dire as it seems? Well, our verdict is certainly not. India has been following a very cautious monetary and fiscal policy, which has allowed us to weather the storm from a position of strength. The challenge we face in the near and medium term are substantial, but we are better equipped to deal with them. So let us first discuss the issue of rising inflation world over and in India. When we examined the reasons behind the sharp increase in inflation, we found that it can be traced back to the loose monetary and fiscal policies adopted by the Wild West to combat pandemic-related slowdown. While the situation has been worsened by the Ukraine-Russia war, it is not the sole reason for the current inflationary situation, as many media reports would have us believe. Since the outbreak of the pandemic, the US government has injected nearly $5 trillion in the economy over a period of 2 years in an effort to support its citizens and struggling businesses. To put this into perspective, the Fed's balance sheet has nearly doubled to $8.5 trillion in just 2 years. This money was printed by the government and pumped back into the economy. With so much of cash chasing fewer resources, inflation was inevitable. To elaborate, if there were a high-end garment store in a neighborhood and all the women in the vicinity were given 2 lakh per month free money, the prices of dresses in the store would become expensive by 5 times, 10 times or even 20 times. The number of stores cannot be increased overnight, but the number of women wanting the same dress has gone up suddenly. In economic terms, this is called inflation when the prices of goods and services increase over a period of time, reducing the purchasing power of money. While inflation in the United States largely stems from the government's continuous cash printing, India's inflation is due to a supply chain shock post the Ukraine-Russia war. This event has made fuel and food imports, including edible oils, more expensive. So the United States has to slow down their economy to control inflation, while India needs to address the supply bottlenecks to bring down inflation. Inflation fight in India is therefore focused on the two fronts of fuel and food. There are limited number of ways to control fuel inflation in India because the country imports nearly 85% of its crude oil requirements. Oil prices have been on the rise since the Ukraine-Russia war. However, food prices have eased up internationally, but domestic factors have taken over in the month of September, when disruption caused by irregular rainfall resulted in the prices of vegetables and fruits to rise. Further, looks like the rising festive demand for clothing and other retail products is also adding to the retail inflation. Overall, we believe that once fuel inflationary pressures subside, things will be far under control for India. The inflation driving factors in India are different from other countries, and India is better prepared to handle the inflationary scenario. According to various estimates, inflation in India will remain within the manageable range of 6 to 6.5% for the fiscal year FY23 before easing in FY24. Now let us see what is happening on the industrial and economic growth front. India's factory output declined for the first time in 18 months, with the index of industrial production seeing a drop of 0.8% in August as compared to a rise of 2.2% in July. Does this mean that industrial output is slowing down? We believe that the recent contraction in IIP is not indicative of any widespread manufacturing slowdown. This is primarily because other lead indicators are strong. For example, urban employment has rebounded 28.5% since pre-COVID levels. Also, the rebounds in job creation across various sectors in urban India suggests ongoing strength in the services sector. Things are also beginning to look up in the rural markets. Manrega work demand has been diminishing since May and was lowest in August 2022 compared to the previous 2 years, which could be signaling a possible reduction in unemployment rates in rural areas. The macroeconomy is looking strong, as evidenced by the 27.5% year-on-year growth in GST revenue in the July-September quarter. This was the 15th consecutive month of double-digit YOY growth in GST revenues nationwide. Consumer sentiment has picked up beautifully this festive season, as we will discuss in more detail in our next coverage on the e-commerce and auto sector's festive demand pickup. However, it is yet to be seen whether or not this will sustain for the rest of the year. Indicators look promising so far, but only time will tell for sure. India remains the fastest growing nation in the world. Even on the GDP front, things are looking pretty stable. We are not economists, so we will go by the projections given by the world-renowned agencies, including RBI. Even if most of them have cut their growth projections for FY23 by a few percentage points, India is still expected to grow at 6.8 to 7%. They are all unanimous in one thing, that India will continue to be the fastest growing nation in the world in the coming years. I think that's the key takeaway for us as long-term investors. Although we believe that projections may be revised a few times due to overall economic uncertainty, the structural growth story of India is still intact. Favorable demographics, rising digital connectivity, and improving consumption trends will eventually put the Indian economy back on track for double-digit growth path, assuming global headwinds subside. Having said that, we believe that in the medium term, Current account deficit would need to be closely monitored because this represents external liability. All global factors come into play here, such as crude oil prices, rupee dollar movement, FII and FDI flows, etc. Right now, things are still under control even when it comes to CAD, but foreign exchange reserves are gradually coming down as RBI continues its effort to stop the decline in the value of the rupee. The Indian government has been smart in how it has handled inflation and the economy so far. It has taken a variety of fiscal and monetary measures to control inflation without harming economic growth. This puts India in a much better position compared to other countries that are struggling with inflation and a slowing economy. Things are currently under control, however, it's difficult to predict which way the tide will turn in the future. To get a better understanding of what might happen, we thought it would be beneficial to look back at history and see if this situation has happened before, and if so, how the world emerged from it. Even though the US is currently facing a period of high inflation, rising interest rates and a slowing economy, it's important to remember that they have been through this before. We are talking about the 1970s, also known as the period of Great Inflation. During this time, inflation rates rose to as high as 12-13%. Federal Reserve's policies that promoted a large increase in the money supply were considered the main reasons for the Great Inflation. Their economy suffered a recession, but eventually their economy bounced back, and since 1970, S&P 500 has generated a CAGR return of approximately 11%. It's important to remember that challenging times don't last forever. For long-term investors, this is like having a deep discount sale on good businesses. Instead of getting caught up in all the short-term trends and analysis, we need to zoom out and focus on the big picture. Even the International Monetary Fund, IMF, has stated that the global economy will continue to decline, but India is still faring much better than other countries. Further, we also believe that the long-term story of India's growth is still intact despite the current geopolitical situation. So, for long-term investors, it is a good idea to keep some cash on hand to buy more shares if there are any major corrections in the market. Brent above $95 per barrel on OPEC supply cut decision. Earlier this week, the Organization of Petroleum Exporting Countries, or OPEC, agreed to cut production by 2 million barrels per day from August 2022 levels, the biggest output cut since the start of the pandemic. So, is this move good or bad for India and for us as consumers? The verdict is that it is bad. If crude oil prices rise as a result of this move, it will increase our import bill and current account deficit. Additionally, if high prices are sustained for a long period of time, retail fuel prices will also increase. So, what is OPEC? Organization of Petroleum Exporting Countries, or OPEC as it is popularly known, refers to a group of 13 oil producing countries. So why are Western nations criticizing a 2 million barrel per day production cut so much? Of course, geopolitics is at play. The cut, which will take effect from November, represents around 2% of the global oil supply and is larger than expected. The significance of the move is because OPEC members produce around 35% of the world's crude oil. Europe, that has high reliance on Russian oil and gas, is already looking for alternate supplies from the Middle Eastern nations. Any supply cut by the OPEC nations will therefore impact their diversification strategy. As for the US, it fears that an OPEC production cut would result in increased demand for Russian crude oil. Now let us look at the reasons why OPEC has decided to cut production. Oil prices, which surged to multi-year highs earlier this year with the outbreak of the Russia-Ukraine war, have started to ease in recent months amid concerns of global recession and interest rate hikes. Oil prices have fallen from more than $130 per barrel in March to below $90 in September. This production cut is an attempt to prevent further decrease in crude oil prices. Usually, $90 per barrel is seen as a key psychological level. OPEC nations that are highly dependent on oil revenue to support their economies normally take measures to ensure that crude oil prices do not fall below this threshold. So, how will the reduction in output impact India? Well, according to analysts, the production cut would take Brent prices above $100 per barrel, which would be detrimental for India's fiscal position. This is because India imports around 85% of its crude requirement, and OPEC members Iraq, Saudi Arabia and the UAE are the major suppliers of oil to India. Recently, India has also increased supplies from Russia to take advantage of cheaper sources of crude. At one point, Russian crude was more than $30 per barrel cheaper than Brent crude oil. By the end of September, it was around $20 per barrel cheaper. Thus, the production cut and consequent rise in crude oil prices will increase India's import bills. The impact would actually be felt on the current account deficit because India imports around 85% of its oil, half of its gas in the form of LNG, and over 60% of its LPG. All petroleum imports put together account for 20 to 25% of India's total import bill. As per government estimates, every $1 per barrel increase in crude oil prices impacts Indian current account deficit by around $1 billion. Hence, rising crude oil prices will have an impact on CAD, but it has to sustain above $100 per barrel to disturb the fiscal math. Now the question comes, will it affect retail fuel prices in India? But won't the rising crude oil prices also mean that the petrol and diesel prices will go up as well? Technically, yes. This is because the fuel oil prices in India are derived based on the global oil prices. However, due to government intervention, the prices have largely been unchanged since May of 2022, even when crude oil was on the rise. On the other hand, even when oil prices fell below $90 per barrel, the oil marketing companies did not cut their prices. Therefore, it is unlikely that the government will increase the retail fuel prices immediately, as the country is already struggling with high inflation. Not to forget that petrol and diesel prices are politically sensitive issues as well. Automakers record bumper Navratri sales. Sales of cars, sedans and SUVs more than double over last year. After a 2-year absence, the festive season brought great cheer to automakers with record sales across segments reported over the 10-day period that ended this Dussehra. So, is the demand revival sustainable? Our verdict is yes. A total of 539,000 vehicles were sold during the 10-day period, which is a 57% YOY increase, and it brought cheers to the industry because sales have been very unstable over the last 3 years due to the pandemic, disruption in the supply chain, and the transition to higher emission norms. We believe that the pent-up demand will ensure that sales volume remain high for the year. In addition, we believe that India's auto sector presents a long-term growth story. The passenger vehicle segment is seeing a rise in production supported by large order books. Order bookings are currently very strong, with some new products from Maruti Suzuki and Hyundai having a waiting period of up to 6 months. OEM production ramp up due to improving chip availability is leading to the best festive season for PVs. Even with higher production levels, robust order position will take 3 months to execute. New models from Maruti Suzuki, Brezza, Grand Vitara, Hyundai Venue and Mahindra new Scorpio, Tata Nexon and Punch is garnering huge customer interest. Resultantly, car makers could sell 1,10,521 passenger vehicles this year, that is 64% increase over the same period last year. Most notably, demand is significantly higher in urban areas as opposed to rural areas. Also, utility vehicles are continuing to surpass sedans and hatchbacks in terms of popularity. Two-wheeler sales have finally begun to pick up in both urban and rural markets, providing some relief for manufacturers who have been struggling for the past 3 years. Scooter and motorcycle sales increased by around 52% this Navratri compared to the last festive season. This is good news for the industry, which has been struggling for the past few years due to rise in acquisition, insurance and running costs following the transition to BS6 standards. Dealers are seeing double-digit growth in urban areas thanks to the return of business and office activity to normal levels and the availability of financing. Financing is more forthcoming now as lenders are willing to lend. Although rural growth is lower than urban growth, it is still positive and is supported by incentive schemes offered by certain OEMs. Although prices have gone up recently, people still expect to see a double-digit volume growth during the upcoming Diwali festival. We are seeing positive growth in tractor festive sales volume thanks to higher discounts, a favorable base effect and aggressive financing action. Dealers have seen positive growth in the Navratri period despite uneven spread of monsoon and some crop damages. Customer sentiment is expected to improve due to expectation of a good upcoming Rabi crop owing to higher reservoir levels. In the medium to heavy commercial vehicle segment, volume is on the rise. The segment's growth can be largely attributed to 4 main reasons. Improved freight availability has increased utilization levels for transporters. There has been an uptick in infrastructural spending. Some improvement in replacement demand and finance availability is no longer an issue. The outlook for the auto sector is looking very good in the short to medium term. Car companies already have bookings of 8,50,000 to 9 lakh units that they are yet to fulfill. With this huge pent-up demand as well as strong bookings, it is expected that retail sales will be booming for the rest of the fiscal year as well. With the non-oil commodities softening, OEMs and suppliers should see some improvement in profitability as well. Even though the general outlook for the year is positive, we want to focus on the long-term growth prospects of the sector. The demand for automobiles is rising again after a few years and is projected to keep getting stronger in the coming years. This is especially promising for the passenger vehicle segment because it's seen as a more structural growth opportunity because of the overall low penetration, increasing affordability and rising urbanization trends. Festive fizz for economy as buyers boost sales. The online retail market touched $5.7 billion in gross merchandise value, registering about 27% growth from a year earlier, according to market researcher Red Sea's 2022 e-commerce festive sales report. GMV represents the total value of items sold across platforms. The festive season in India, which starts with Onam and continues through up to the new year, is crucial for many companies as it can account for up to 40% of their annual sales. This period is especially important for businesses that sell discretionary items such as mobile phones, TVs, home appliances, cars, and fashion merchandise. This pickup in private consumption is good news for India's economic growth because globally demand is impacted amid fears of recession. So, a 27% YOY growth in online retail GMV during the first festive week is quite impressive. Some other highlights of the season include e-commerce platforms saw a total of 75 to 80 million shoppers place orders during the holiday season. This was a 24% increase from the previous year. Nearly 65% of shoppers are from Tier 2 and Tier 3 cities. This is because consumption in smaller cities typically spikes closer to festivities like Diwali and Dussehra. Flipkart Group held on to the leadership position in online retail sales in terms of GMV, with Amazon coming in at a close second. The Flipkart Group held majority market share with around 62% on a GMV basis. During the festive season, over 56,000 mobile phones are sold per hour, which contributes to around 41% of the gross merchandise value. For smartphone retailers, this time of year accounts for more than 20% of their annual sales. Fashion items were also among the top selling products this holiday season, and they made up to 20% of the total GMV. That's 48% higher than last year. Fine, festive demand is very strong, supported by the pent-up demand of 3 years. But we believe that this trend is more structural in nature. According to another study conducted by Bain Capital along with Flipkart, India's e-retail market is expected to grow 3 times in size to $150 to $170 billion by 2027, a CAGR of 25 to 30%. Notably, growth in e-commerce would result in near doubling of the penetration levels as well, that is from 5% to currently to 9 to 10% by 2027. The number of e-retail shoppers in India is expected to reach 180 to 190 million by 2021. Most of these shoppers, which is approximately 60%, come from Tier 3 cities or smaller cities. Gen Z, those aged between 18 to 25 years, is beginning to transact online and will become a key group in the future. At this rate, India is on track to overtake the United States as the second largest user base within the next 2 years. The mix of categories purchased online is also expected to change. Fashion, general merchandise and grocery items, which currently have the lowest market penetration, will grow at a higher rate than other categories and are expected to make up 2/3 of the e-retail market. The secular growth of the market is supported by strong underlying fundamentals such as large consumer base with growing affluence, increasing internet and smartphone penetration made possible by low data prices and low shipment costs. Together, these factors create a strong market that is ripe for continued growth. So what do you say? Should we go shopping this weekend? Or if you're feeling too lazy, I suggest you make yourself a cup of tea and find a good book to read. I highly recommend reading The Story of Tata by Peter Casey. It's a great book that provides insight into the business philosophy of the Tata Group. I have always admired the Tata Group. Through this book, you will be able to appreciate the unique culture they have been able to preserve for over 150 years. I knew that Tata Group does a lot of philanthropy work, but this book helped me understand how that came to be. The book is full of interesting stories about the people behind the Tata Group and how their work has helped make the world a better place. I would recommend it to anyone interested in learning more about corporate social responsibility. It's made me realize that the Tata Group is probably the only business house that has been able to strike the right balance of capitalism and socialism. With that, I take your leave and have a great day ahead.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.